All right, what's going on, you guys? Back at our live stream on YouTube. It is a very crucial, important day for the markets today. We've got our FOMC rate cut. They already did announce that there's going to be a cut. We are waiting right now for Powell to speak in about 20 minutes. I've got our live stream up here, so when it does happen, we should be able to see it. Haven't really done this before in terms of streaming a stream while I'm on live stream, but we'll see how it works out. Everything should be set up properly already for us. While we wait for that, just wanted to talk a little bit about some other things that have been happening with us. Today we saw a Lyft rocket ship. We saw some pretty awesome profits with it. We did get some confluence from Stacks AI just yesterday, and also earlier last week we saw some Lyft calls come in for 2026, mid 2026, and then we also saw some for December of this year. These ones down here, the 25 calls for June of 2026, these ones were over 100% return. The Lyft calls for today, or that came in yesterday for December, the 23 calls, those ones shot up and were around 80 to 90% return. So if you were able to take those, I know a lot of our members in our Discord and in Stacks were able to, so saw quite a few people post their profits already. We do also see, so Baidu has also been going up crazy. Baidu apparently had a agreement, AI agreement. So I think they're starting to work on their AI, and they rocketed up quite a bit as well today. So a lot of good plays so far. I mean, I'd say over the last 3 to 4 weeks, we've been on a heater. Max and I have been doing our best to call out as much as we can. Been sharing the things in our Discord, so if you guys are in there, make sure you hit that emoji button and let us know you're out there and listening as well. Yes, Dylan, we see quite a bit of, I think it's pretty common, there's a lot of hedging that's been going on. If you just go look at the ETFs, like what they're buying right now is all to the downside. Like, yeah, we got an IWM. You could expect that with IWM we might see IWM pop a little bit with the rate cuts being announced, but overall there's a lot of downside coming, I would say. Here, let's take a quick peek. Yes, we just saw SPY pump like crazy, but it also just dropped, so let me share that with you. Just saw SPY, what was this right here? We saw SPY pump from the lows to the highs about 0.5%, and then it's just dropped all the way back down. So, I mean, that's all, there's going to be selling off with this news. I think that's kind of what a lot of people are expecting, that we're supposed to see a sell the news event today. We'll see what ends up happening. When Powell shows up, there is a tendency for the markets to potentially pump, but it's, we got to see what happens. There's no guarantee of it, but what I already did was I got out of quite a few of my positions just to be safe on it, looking to re-enter later on after the decisions have been made. I got out on Lyft, made a pretty penny on it, having a pretty solid day already with it, and the only one I'm still in right now is Snapchat, which has been moving pretty strong. We've been in this one for quite a bit. It should hold $8 is my expectation. I'm gonna leave an alert on this. Let's see if we can get this. I think we can see this go up higher in time. Why is that not moving for me? Alright, I'll deal with that later. Let's go back to Stacks. Let's see what Stacks has to say, and then once the conference starts, I've got it playing right now, so it should, I'll test out the volume and everything too as well. If you guys are here watching, go ahead, say hi in the chat box for me. And always, as a favor, please go hit that like button for us. That way we can get this algorithm on YouTube to favor us a little bit, push us out more to some more people. We officially hit 4.6 thousand subscribers on our YouTube. We're trying to get this to 5K. So let's help us out, guys. Go ahead and hit that subscribe, hit the thumbs up button for me if you guys can. And we've got Max in the house.
What's up, my splurging virgins and girls who be curbing those OnlyFans subscribers? It's your favorite market analyst who's here to stick some beads inside of you. So, Eric, what is up, my dude? It looks like, fun fact, if you guys subscribe to my Substack, because Eric subscribed, by the way, just in case you want to know how good it is, I gave you all 3 scenarios you need to know. So, Eric, I'm thinking maybe we can dive into this before we get into this FOMC meeting of what people can expect based on Powell's tone, and if he's going to be a dove, a hawk, a fairy. What do we know, right?
Go for it, Max. Go for it.
So, scenario 1, the dovish pause, which is the most likely outcome here. This is the soft landing scenario that the market is hoping for currently. So, what is it exactly, you're probably asking yourself? Well, the Fed holds interest rates steady, but the official statement in Powell's press conference are filled with dovish language. He explicitly acknowledges the weakening labor market, the rising unemployment rate, and says the Fed needs to be mindful of the risks to employment. Now, the market reaction to this would be bullish, because at the end of the day, what is going to pump the U.S. economy higher? More jobs, because we're currently in a revision area of almost 1 million jobs that were misrepresented over the last 18 months, let's call it. Now, scenario 2, we have the surprise cut. This is the wild card scenario that would cause the most volatility. The Fed shocks everyone and cuts rates by a 25 basis point or 0.25%. Now, it's not necessarily a shock because it's been priced in, but we're going to see some extreme volatility, because then everything is going to be dependent on what Powell has to say moving forward in that press conference, right? Because if we already have that cut priced in, then we don't need to wonder what's going to happen. We need to wonder, what does the future look like, especially when we just had a new Fed member voted in by 1 vote, by the way, 48 to 47, a day ago, who can now bet on a 50-point, which is scenario 3, the hawkish pause. So this is the scenario the bulls are dreading. They hold rates steady as expected, but Powell's language is surprisingly firm and aggressive. He dismisses the weak jobs report as just one data point, emphasizes inflation is remaining elevated, and pushes back hard against the market's expectations for imminent rate cuts. Now, that's where we will see a market dump. Right now, the Fed is in a nightmare position of having to save the job market but also curb inflation, because at this point, with what inflation's at, you can't save one without hurting the other. So if he cuts rates aggressively to save the job market, we'll see a spike in inflation. And that's just the reality. So right now, I'm betting on a 25% basis point cut. We should see IWM surge. Off of that, we should see probably SPY dump, in my opinion. So we'll see a sell-off on SPY. And I also don't think with the China blockage on going mainland for their AI chips is helping SPY be a bullish case either. I also dropped a recap and kind of like what's going on exactly with that. So I definitely see SPY dumping here. IWM running to about 242 to 244. I see SPY dumping potentially down to 560.
It's fair. I think that's fair. If we peek over here at stacks or at our charts on TradingView, we're already seeing SPY. It's kind of making a little bit of a bear flag pattern right now, so I wouldn't be surprised to see it head down further. The tendency is, though, when Jerome Powell, I mean, there's this joke about how depending on if he says good afternoon or something else,
Yep.
that the markets go in a certain way. We'll see. There's also a lot of talk on Twitter, but obviously you gotta take this with a grain of salt that everybody's expecting it to drop, so that market makers are actually going to move things up. Nobody really knows. We're gonna have to see once it plays out. As of right now, we did see quite a bit. We saw a big pump and a sell-off. I mean, it's still pretty flat for today overall when you consider it. Considered from where we started till now, it's kind of it's chopped back and forth so far. Volatility is starting to spike, so we can expect that. It is also VIX expiration today, so we saw VIX pop just a little bit and it's come back down just so far as of right now. So we'll keep an eye on that. I just got an alert that Snapchat just dropped down below 8. Looks like it popped right back, so those might be all right. I was considering maybe getting out of it and then looking to get back in after FOMC. But we've got about 5 minutes. I mean, sometimes Powell's a little bit late, so I would say probably in the next 10 minutes he should be showing up, and we'll get this.
How are you feeling
going.
about?
So, I think 25 is expected.
Yep.
My theory and my thesis here is the fact that the economists, all the data-driven economists, are saying 25 because we don't want to make the same mistake that we made last time, where we cut too big and then inflation comes back. And that's the whole reason why we're still in this situation right now, is because we went too big too quick, and that ended up hurting the markets more in the long run. Yes, while we still see everything running up toward all-time highs, there is the safe, steady way is to go with the 25. Politicians are shouting for 50, and all the politician-backed economists are aiming for that because they want to see, they want to appease the president. They want to make sure that Mr. Too Late Jerome Powell is proven wrong in this situation. But if we know Jerome for who he is, he's always been data-driven, which is the right way to do things. There's been a lot of criticism about that, which makes no sense. You're like, half these people want to make these decisions off hopes and dreams instead of actually looking at the numbers.
Yep.
The data revisions for the jobs numbers has been extremely crucial in pushing for this. Even though it does look like it's so bad that we could possibly use a 50 point, it is better to go small and slow than to go too big and have to regret it later. So for the sake of the economy, I want the 25. I want them to come up, let us know about a plan. The thing that I think the markets won't like is if Jerome comes out and says, we're going to let the data speak for itself. We're going to see when we're going to do the next cut. It's not necessarily planned just yet. That's what's going to spook the markets into thinking, okay, he's not going to continue to cut in these upcoming meetings, and ultimately is, we might see some sell-off. But with the way that the markets are also moving, if I pull this out to a bigger picture too, markets are just in this channel. I already said that I wouldn't be surprised to see a pullback to 1 to 2% even. Might, to some people, like you're gonna hear the news go nuts about, oh my god, everything's crashing. But realistically, from where we are right now, if we just drop back to kind of where the trend line is, 1.5% even, worst case scenario, back to the bottom of the trend line, 2% back down to 650, 10-point move, okay, life goes on. But you're gonna see the markets attack Jerome Powell for it, which I think is unwarranted. But that's kind of just been That's just been the game so far. That's just been how things have been working out for it. So, unfortunately, it is, when politics are mixed in with it, we gotta take certain things with a grain of salt. So, yeah, that's my take. 25 markets should react maybe a little bit to the downside. See maybe it down 1% or so, and then we'll probably go back to business as usual in the next few days. It could take till Friday for us to fully digest it, but ultimately it shouldn't be too bad.
Wow, IWM shot up, baby. I sold those calls a little bit too early, it seems.
Right now, it's really it's volatility. It's as if the entire market is going through an earnings situation. IV is spiked. Contracts are going to get a little bit more pricey. It is what it is at this point. So,
SPY touch 661 is at 659. Eric, you want to play some? You want to play some lot of contracts?
I'm gonna sit and watch. I've been waiting for this to play out so that we can get into some quality positions afterwards. I will say too, though, our 1K challenge, if we held on to KWeb till today, which I wasn't going to be the biggest fan of because it expires on Friday, that would have gotten us another 100% back on those KWeb contracts. We would have sold and made a total of, I think, over a G off of it, which would have more than doubled our account. Right now we're sitting at still about 50%. We're waiting for American Airlines to play out. And American Airlines and Alaska Airlines just had a deal with Bill Gates to create some sort of breakthrough energy situation. So we are seeing American Airlines finally move back up. Not quite even yet for it. I was also talking about how I wanted to average down after FOMC, so we got to see how this moves afterwards. But I think all eyes right now are just on SPY. If you want to take lottos, go for it. That's on you. I will fully support and help you out and cheer for you the entire way. But as of right now, I'm not gonna bait any of our listeners and followers to get into anything, because again, some of these are gonna be a little bit of a gamble.
Oh, 100%. These are going to be a gamble. I think the biggest winner is going to be IWM.
Yeah, I agree. Small caps are going to pump because rates go lower, and it's going to help them out the most.
Yep. And that's what people are going to forget is SPY might dump off, but IWM, when it pumps to 250 by end of day today, don't be shocked, because those are the ones that are the most sensitive to any type of cut being delivered, which those are always going to be your winners. It's going to be IWM, because at the end of the day, that's what anything that's small cap under anything that's under IWM, it'll pump up.
Alright, we got him on, or at least the screen change. Let me know, guys, can you hear the audio? I have it on kind of low, but the audio is on. I'm going to make our screens a little bit smaller so you can focus on Jerome and his beautiful face.
Jerome.
I'll put...
What's up, Jerome?
Let's do this. Oh, there he is. Let me know if you guys have, if the volume's working. Cool.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments.
We got 25 people in chat.
Recent
right
indicators
now.
suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak.
To holy heavens here.
In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation.
Drop on SPY.
Overall, the market slowing in both the supply of and demand for workers is unusual.
This is what will happen.
In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen.
We're going to see a chop, and then we will
in
see
our
an
SEP,
pump.
the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
659.80.
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well at businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Everything's expected.
Thank you. Chris Rugaber, Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time
we're seeing
I believe the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry. Can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead.
Here we go.
Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank
you. You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Oh my God, IWM. Just tanking.
From the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August,
crazy.
You can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think
right, audio should be better
we've
now.
done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening, or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation.
There that is. He said we're waiting for more data.
Individual projections of 19
See
people,
how we react to
showing
that.
what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer then. In fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noise?
I mean,
so
big
on the
picture-wise, this is
QCEW,
like less than a
revision that we saw was almost
less than
exactly what we
move.
expected. It was amazing how close the
0.7%
expectation was. So,
move,
and the reason for that is, for the last bunch of
on
quarters,
these.
there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies, and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work.
But we also see it recovering.
To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 1/4 percentage point now is going to arrest that?
Well, I didn't say that I thought a 1/4 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower
SPY recovered nicely
that shows
right
you that
there.
At the margin,
657,
the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low.
Look at that comeback, SPY.
Downside risks, but it's still low
I
unemployment.
was saying it already.
That's how we see it.
Damn near recovered.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see
Real quick, peek over at stacks, guys. Look at this. They bought the dip.
You can take goods, just sort of the broad goods category.
All this money came in
last
and we
year.
Saw that run back up.
Goods inflation was negative.
11.55.
If you go back 25 years, that was the typical thing. Was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic. Of course, goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing.
11.55.
What seems to be
this is everything,
is
buys and
that,
sells.
There's
nothing bearish right now.
Mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today. I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
I mean, with how things have been, let's not act like we're all shocked.
Financial Times.
This was
given the range
of
of views expressed
FOMC
prior to the
day.
meeting, I think there was a lot less
I feel like
dissent
we've
today
had
than a lot of
rate
people
cuts priced
expected.
in
It'd be
to
good
this
to know
move for the
just what you
market
think the drivers were of coming to that very strong consensus in the
June,
meeting.
damn near,
Also,
when
on the
everyone
flip
said
side, to just
it
explain
was
why
too
the
late.
plots are really so scattered between someone who can
Powell
This
at this
recovery,
point,
man. This
I know,
recovery
is insane.
I said yesterday in our chat, we're gonna sell the news and then buy the fucking dip.
And on the flip side, why there's so much divergence.
And Stacks was on point. Stacks spot the dip. Guys, look at Stacks right now. If I scroll back on all the buys started at 11:55.
Time of the July meeting. The labor market
Right here,
so
11:55. Tesla started, Baba, Nvidia, PDD, AMD, Starbucks, Amazon, Tesla, Broadcom, Google, iBit, CoreWeave, Baidu, QBTS, man, everything, and it's still going. I haven't seen a single red print. I haven't seen a single red print in about 12, 13 minutes.
And so that meant different things for different
guys.
People. Some wrote down.
Seriously.
Everyone wrote down, supported this.
We're bullish AF for no reason,
some
boys and girls.
Cuts and some didn't, as you will see from the dot com. So
we are bullish AF on a crumbling economy.
And look
That's
at it.
America.
We recovered from that moment. This down here is 11:50. 11:54, 11:55 was the first big green candle pushing right back up.
Between ourselves, and then we have a meeting where we put it all out on the table, and this is what you got.
That's crazy.
You're right. There's a range of views in the dots, and I think that's, like I said,
man,
very unsurprising given the
tomorrow's gonna be wild,
historically unusual nature of the challenges that we face.
Tomorrow, fast money tomorrow. Ooh boy.
At 1.5%. So it's not a bad economy.
It's going to be.
We've seen much more challenging economic times, but from a policy standpoint,
open
up
some buying power,
it's challenging to know what
we're going to see an aggressive move one direction or the other on multiple different sectors.
It's not incredibly obvious what to do, so we have to keep our eye on inflation. At the same time, we cannot ignore. We must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to.
Tomorrow's going to be an interesting day.
None of them is perfect, but it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. There's just many different ways to do it. So wherever it was, 150,000, 200,000.
Trading days like today, though,
quite significantly, and that's because
it is not easy to have.
Very lower amount of people are joining the labor force. The labor force really not growing much at this point, and
it is not an easy task by the slightest.
Coming from over the last 2 or 3 years, so we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment.
I guess really what it comes down to is what is that magnet point for SPY? But it looks like 659. Let's go ahead and look at Trader Link. Yeah, that magnet is 659.30 all the way up to 659.90, and on the downside of 658.60.
How do you square those things? Is there a chance actually the upside risk to the labor market?
Meaning that is where
love that to happen.
So you could look at it as 658.60 is where buyers start to step in.
It's a good
sellers are starting to sell off around 659.20
this week, I guess,
and 659.80.
Sector is producing.
We're basically at point of control right now.
Yeah. Well, I was gonna say that's kind of like how you establish a point of control at that point.
We watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the S&P between June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's.
So really, we could just say 658 is the point of control.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question.
Needs to break that one way or the other to make a
Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to 0, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going.
Oh,
was
wow,
that we cut so aggressively,
is that
like
battlefield
that.
And
they were
bottom being
because we did that. The other side of that is when inflation gets high and we raise rates, and you're right.
That's like the point of
the
where
housing
it's
industry
reject off of.
So
and then
rates
that high
have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Rates for builders will help, builders will help supply. And so some of that should happen.
I was going to say
we have to be.
We're not going to
changes for it.
We're not going to see much more movement outside of rates for this point. Like that's why I was saying.
And the other thing
tomorrow
is
we'll see some clear-cut direction based on what the big boys are going to be doing for the long-term positioning.
And then the last thing I'll say is,
so look for anything that's
there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a
November and December, because that's
a lot of places in the country
expiration
just don't have
we should start seeing.
Housing for people.
But this is pretty much it, folks.
Yeah.
That's FOMC movement for you. It seems like a lot, but it might not be a lot,
You seem to indicate that
All right. Wanted to go over some stack stuff. I think we've seen basically what we need to see for FOMC. At this point, I want to point out, like I was saying here, let me move our I was saying, as soon as we saw 1155, which is the bottom, we saw a couple of IWM puts that were still taking, but the moment it flipped green, you see that 1155 and on, yeah, we got KRE, but everything else just green the whole way. The first puts that we saw just started coming in about 2 or 3 minutes ago, but the bottom right here, 1154, 1155. So basically, stacks started to show all that flow. If you're a scalper, that would have been, you know, would have basically been a godsend. You could have, oh, let me flip it to right there. So 1154, 1155, that's where it's at. We see this big move up. SPY is basically flat for today. We saw a bunch of volatility, like we all expected that. That was, you know, and anybody would have expected that in terms of FOMC. We called out that we're going to see a drop. Drop wasn't even as big as I kind of expected. I expected to move at least a percentage point, so probably down to 650 or so. But we were recovered at 654. I think we could be, we'll keep an eye on stacks, but I think we could be looking to recover and to head further up. This is starting to look like a possible head and shoulders. We just got to complete it right now, where we have a shoulder, head, and if we recover this, I think we could head up further. Looking at stacks, what are some plays that we might want to get into? Well, we see some big money coming. We got some Tesla coming in here. It's in the money for Friday, so not as aggressive, but Tesla should hold 420 and 425. These PDD ones look interesting. October, end of October, 145. We also got Baidu here, so I think we're going to continue to see China run up. See Baba, PDD, Baba, Baidu, PDD. So those are some good indicators. Shoot, man. Some more Baba came in.
I mean, are you shocked though? China just banned the sale of NVIDIA chips. Yep. So Baidu, Baba, Kweb.
Yep.
All those companies are about to start popping off because guess what? Chinese mainland companies that produce the majority of the stuff we consume, they're going to need it. Yep. So watch for those pop-offs.
Yeah, Baidu. I see some Intel in here too. Starting to see actually quite a bit of Intel throughout today. I think we might see a pop for, well, because I think we might hear some news about that. We might see something happen with Intel.
I feel like that's going to be another like U.S. government stake deal type thing. Where it's like, oh, well, China wants to block NVIDIA sales. Well, we're going to double down on our Intel. Like, I don't know. I feel like that's some dumb move we would make as a country.
Thoughts on Broadcom? I mean, the good sign is after this meeting, well, we see some for Friday, 350. We should see a little bit of recovery for Broadcom. The Stacks AI one came in on the 11th. These ones are down. It's $20 from where it was. But I mean, you got to keep in mind those are for June of next year, man. You have so much time on that. Well, do I think Broadcom's going to be higher by that time? I think there's a very solid possibility. And I would even say the continued buying that we see today after FOMC give you a little bit of confidence that we could see more. Here's a good one, JD. Let me pull up some charts real quick for you guys. So let's review. So Lyft, I think, should head further up again. I think we got time for this. I was going to get back into some Lyft calls. I sold at open today just because we saw a huge pop and it started to run back down very quickly. There was news about how Lyft and Waymo are going to partner to launch some robo-taxi stuff. So we saw a huge run up. This is actually, in terms of it, it's right. All right, the whole move came right back down. It's chilling right at the 0.618. I could even say if we go from this range right here, bounced at the 786, back at the 618. I would still be bullish on this overall, especially with Lyft having those Stacks AI prints. Obviously, I got 100% on my positions for that already, so I might start to find my way back into that in some time. We got BABA BABA held up pretty well during this FOMC meeting. Obviously, I mean, you know, it's not very much affected by our rates here in the U.S. We should see BABA head up higher in some time. We saw JD, same idea. JD's up at that gap that we had above. It just needs to break back out. We saw Baidu, which had the AI announcement. Yeah, it's already headed higher right now. FXI is a good way to play these if you want a little bit of it's a little bit of a slower mover, a little bit cheaper. These are all the large cap ETFs for China. So you got BABA, Baidu, JD, those types of things. PDD, same thing. All of these are looking strong. Man, I got out of my PDD yesterday because I didn't want to hold it through FOMC. Those ones would have doubled in return. So Stacks is still showing a lot of good buying happening. It's all still pretty blue and green. Unusual positions getting taken. Got BABA for next year 220, over a G per contract. This is a cheap one. NEO, February 20th next year, $11 strike. Go ahead, comment in our chat box. Let us know if you're still here watching. If there's anything you're looking at, just kind of watch our flow. Amazon keeps getting a couple of buys for January. See Palantir coming back in as well for the end of the week. It really didn't sell off as hard as I actually thought things would. I basically held on to Snapchat and American Airlines. Those dropped a little bit during the meeting. They've come back a bit. My Snapchat position's up about 40%. I mean, overall, I had a pretty solid day, so. Yeah, if you're looking at Baidu, okay, obviously you don't want this one for Friday. It definitely could move, but that's too big of a risk. I don't like that one. This October 10th, that's kind of an awkward expiration. But 150 calls, $4.30. You also have these for the end of this month, so end of next week, 150. Definitely could see it move. That's what I think. I definitely think we could see it move. I like these November ones a little bit more. I like to make sure we buy some time. The issue with this, I want to take something for our 1K challenge, but some of these are still kind of pricey. I don't want to buy next week's.
Yeah. I think
the
1K challenge, we want to be like minimum 2 weeks to a month.
How about this one? This is tempting. RGTI, we saw about 8 instead of 15 mil right here for next Friday. $23 calls. It's pretty close to it already. It's only a 4% move.
I mean, if you believe in the quantum space, I would 100%.
It's moved hard already too. It's already moved hard.
So, do you want to wait on a pullback then?
That's what I said about Baidu yesterday, and look at how it reacted today. Man, I was just like, yeah, wait for a pullback on Baidu. It's moved up hard, and then we see it pop. I think it was like 10 or 15% today. It was like 10% overnight.
It said, "I'll pop without you, my brother."
Yeah. I mean, again, you gotta take the probabilities with it. There's gonna be plays that you miss out on. You gotta learn not to FOMO on it, just because it's a situation where it very easily could have gone the other way. Man, it's crazy right now. When you look at stacks, we see a few reds here, but okay, CDE, we saw some puts being taken out just now. We're really not seeing too many puts being bought at this point. Like, less than a handful. I counted on a single hand right now. So filter for the buys. We see IonQ being bought here, $3 per contract for next Friday. QQQ expected to move up or stay where it's at by tomorrow or by Friday. We see some Affirm right now. What's my opinion on MU stacks call out? Bullish. I mean, the call out with stacks, and the thing that you want to consider today with it, let's see where it was. It was this one. It was a combo. So you got a buy of the calls for 200, and then you have a sell of the calls for 280. And so they, well, realistically, they sold a lot of these calls, way more than they bought. Okay, but the idea here is that it came in together, so they're expecting a decent move, but it's not necessarily going to go past 280 is kind of where they drew the line on the top. I think it's a solid play. Earnings obviously is always a gamble, but there has been quite a bit of unexpected money flowing toward MU, RTX as well. RTX shot up like crazy. I got out way too early on that one. That's like a multi-banger at this point. But if MU's reporting next week, I think that's a good solid one to consider if you want to. The price of it is a little bit high in terms of it because they bought for December, but I will not be surprised if we see Stacks AI call it out again and hit. Oh, hey, we see some Verizon puts being bought. But again, we're not seeing any of the real big names really, popping up here when it comes down to the flow. Flow basically gave it to you guys. I was too busy watching the chart, but I looked over and I was like, man, that is all green. That is all green. Oh, there's another one of our favorite Wolf. Freaking 5Xer when I took like 100-something% on it, and then it turned into a 5Xer the next week.
Don't worry, Eric. It's not a 5Xer. It's actually a 674%.
Thank you.
But don't worry, if you would have bought the Stacks AI Google $200 calls, everybody who sold out early on those are currently up 1,538%. So you would have bought in at $3.15 per contract, and they're currently worth $51.58 per contract. And for all of you who sold early on PDD, don't worry, you missed out on 243% in profit so far. So
I'm about to mute you. You're pissing me off. Yeah, I'm looking at, there's a Google call out that was, the contracts were 17 cents each. They're now over 200, like almost 300. I don't know, I kind of have this feeling, guys, you could throw these prints that you're seeing, these buys on stacks right now, put them on a wall, throw a dart. I'm guessing we're gonna see the markets higher right now. See a lot of Netflix that just came in. I think right now it's kind of like with you know, you see big money just pouring their money in right now. There's a lot of short-term stuff. There's a lot of stuff that's expiring next week and the end of this week. There's a lot of in-the-money stuff. I think they're just trying to get shares. I'm just looking for a contract or a play where it's not going to be too... I'm trying to get our 1K challenge back into it, so... There's those Cisco ones, but that's a small expected move. Man, look at those Tesla getting bought right there. Man, they spent 10K on per contract on that one. Yeah, something's going... Look at that. Tesla just... Look at that. Just Tesla all over the place. I will say I still like Lyft, and I like the chart in particular. I think it's going to head up higher in time. We might see a little chop around where it's at right now that the news came out about it. Oh, is that AI? Yep, Tesla AI. These two down here. Only issue is it's 9K per contract, so I'll let you decide.
I mean, Lyft long term is not a bad move.
Yeah.
If we're being honest. Like, Uber's big question was robotaxi or like autonomous vehicles, right? Lyft is their biggest competitor, so Lyft was obviously going to be the next in question. And if you're able to sign a deal with Waymo, who's, by the way, been doing like autonomous rides for longer than I think people understand or realize, then signing a deal with a company who's already kind of put their foot, especially in the San Francisco market, because if you ever went out late night in San Francisco, you saw 4 people crammed into a Waymo vehicle, like tracking all of the different areas you can go into. So all positive signs for Lyft in terms of a partnership deal.
This Big Bear one is interesting. So apparently one of the politicians is that makes decisions on the committee for AI and stuff like that, bought Big Bear very recently. That might be a good play here too. I actually see a couple of these purchases right now. This is the cheap one. Should go for October 17th. I want to buy a few of those. I'm going to do that for our 1K challenge. Let me pull that up. Let's go 5 contracts on the 50-cent ones. We'll just do the whole thing. Sell, yeah.
Tesla's pumping.
Yep. It should break over 430 soon. I think that's definitely a possibility. Near-term possibility.
Yeah, but we're talking low a day was like 411, and it's at 427 right now.
Alright, I'm gonna get into Big Bear BBAI October. Let's go October 17th. I'm gonna get the calls for $7. I definitely think we'll see that. I'm just gonna buy 5 of them for now. Right in between bid and ask. See if that hits. I think RGT. I want to get into some RGTI too. Man, these are all so short term too. RGTI for next Friday. What is going on with that? I'm gonna peek over at the contracts. RGTI next week calls for 20 and 23. Man, they're already up 140%.
RGTI moves really, really fast, by the way.
Yeah.
It's one of those ones where if you don't catch that golden sweep that came through for it, you're probably behind the 8 ball at that point. Because those are also the same contracts where you'll be down 50% and want to sell them off because you're just like, I don't want to hold on to this, you know?
Yeah. Seriously, guys, there's so much going on right now. If you go ahead, leave it in the chat, or if you're in the Discord, go ahead and leave it in the main chat and have a conversation in there. I'm going to screenshot a few of these that I think are worthwhile to look at and for us to potentially get into. Like, yeah, I mean, look at PDD right now. The hard part is that I'd be careful. Be careful with the 919s. If you want to take that risk, it could be a big payoff, but it also could very quickly, this next 2 days could go against you. I would be careful about that. China names, if you buy some time on China names, I would not be surprised to see those go up in due time. At least I like these JD ones over here. JD for January, $40 strike. JD's kind of lagging behind the rest of them. Baba, definitely, we're seeing a lot of good flow for it too. All right, look at all that. Like I was saying yesterday, if you're patient after FOMC, there's going to be plays to get into. Mara, what's interesting is we don't see anything being bought after FOMC reported today for Mara. Looks like they're still in these ones right here. I mean, that's got time. This is one of those ones you got to be patient with. Could be the next earnings. It could be just waiting for Bitcoin to rocket off. It is a Stacks AI print. You know, it's not uncommon to see some Stacks AI move down a little bit. You know, 20, 30, 40% before we see them move back up. What I'm really looking for right now is to see if there is any buying after a FOMC decision today. If they're still willing to put money in there after this, I mean, that's something that we need to consider. I saw some Wolf as well. Neo here. This could be a cheap play. I like those February ones. Try not to spread yourself too thin on some of these guys. I'm just showing off what I'm noticing in terms of the flow. I saw Wolf. Let's see, Wolf. Yeah. Might be time to get back into this. Let me check the chart. Man, Wolf's at 11 now. So basically those, yeah, that position, just like Max said, is higher than when we got out. Probably expires soon too.
We have till November 21st on that position.
Definitely got out too early on that.
It's only up 685%. Right
you
now.
Watch your mouth. Let me check the better. Let me check the buys. Only one of my contracts for BVA I filled so far. Still waiting on that one. Yeah, it's at the top right now, but hopefully we'll see a little pullback. Yeah, more Wolf actually. Next week. See QQQ calls coming in for October. See more Tesla. Holy Tesla. Yeah, look at all that Tesla that just came in. They just effectively dropped what? There's 13, 20, like 25 to 30K, or 30 mil, not thousand, 25 to 30 million dollars.
I mean, it's all good. Elon just made a smooth little 24 billion on his $1 billion purchase on the stock that made it pump 8%. So just a casual flex over there on all of us peasants that can't afford to spend $1 billion to buy our own shares of our own company.
Oh my God, there's so much going on. This is almost overwhelming. There's too many to choose from. That's the other side of it.
I'm just happy I'm out of buying power, so I can't do anything till tomorrow morning. So.
I have plenty of buying power right now, but I'm trying not to
okay, well,
myself.
why don't you go buy some Tesla weeklies, all right? And make us all rich.
Another Tesla Stacks AI just came in.
Oh, Jesus. What's the strike?
790. They doubled up on that one. I think all these are actually 1, 2, 3, 4, 5. Technically, that's 5 of them.
Yeah, no, I'm seeing that. 80, and you got like an extra 8 grand laying around. $80.38 on the average. Excuse me, sir.
Yeah, somebody's got some money here. 3 mil on it.
Like, go find a sugar baby or something.
Alright, just look at all that Tesla right there. Tesla. All unusual. All came in today, too.
And for
big money.
2027, dude.
Dude, my phone keeps going off about these Tesla. It's all the same strike, too. Yep.
Dirty 30. Dirty 790. No, not talk about my mustache. Wow. Like, come on, dude. All Tesla coming in at an $80 average. 850s even for 2028. That's a bold risk, Cotton. Let's see if it pays off for him.
Damn, these ones aren't even cheap either. 150 for that. That's already gone up more. Shit.
Dude, that's what I'm saying is like, it's Tesla. If you know big money's going into those longer positions, everything's about to get juiced to the tits like it was made out of silicone. We're not talking about Chinese silicone that's going to take over the Nvidia market that we haven't even touched on, so.
It's K-Web right here. These ones might be worthwhile. $50 for November. I kind of like that one. CoreWeave's a good one too. These ones are kind of pricey, but December. Max is our master of analogies. If you guys watch his videos, he's always got some good, clever stuff. The guy that was asked about Broadcom, you got some big money here, 1.5 mil for December, so that's a good sign. Will my K-Web get filled? I gotta move that up a little. There we go. 64. Let's get it. Oh man, Tesla is so expensive. Chipotle. I will say Chipotle's been beat down pretty hard. I think we definitely could see it start to recover soon.
I don't know, 800K on a 5% expected move is not something to flash your butthole at, you know.
There's
5,000.
There's not very many things you should be flashing your butthole at to begin with, so
exactly. So
obviously.
5,000 contracts at a $1.60 average, you know, I risked more for having a kid at 22 than I did for those contracts. I can tell you that much. So. Thoughts on Google puts? I don't know.
I don't know if I would bet against them right now. I don't think I'd bet against them.
With Google, the thing people don't understand about Google is they have so much free cash flow right now that they can just risk it for the biscuit and invest into shit with no real hubris or like second thought for that matter. So betting against Google would be like betting against LeBron James when he had a hairline. It wasn't a good move at the end of the day. So right now, betting against Google, that's like betting against Mark Zuckerberg before he got some testosterone injected into his system and started acting like an actual man instead of his wife's second wife, you know? So let's be honest here. You don't want to bet against Google because they just beat a DOJ case, like 50 Cent beat death when he got shot 9 times and made a diss song about it. So you want to bet against a company that's willing to go, yeah, DOJ, go ahead, probe every single one of our business aspects, and you still won't make us sell 2 of our top line business models, which are Google Chrome and fucking Android. As soon as you saw that, you should have Grinch dicks all throughout the chart at that point, because guess what? Those are their 2 biggest money makers. Because they do have to share data on search. So that will hinder their market on search. But at the same time, AI might take search over completely. So Gemini, ChatGPT, Open, all these big dick companies are about to come out and have a piss measuring contest to see who could do it best. So Google's search method might be like a fucking fat girl during a day shift stripper shift. No one wants to go see that. So we'll have to just wait and see what happens with search in the future, because that's really their biggest hindrance, because they got to share that data with Bing and everybody else. But they knew that was going to happen for at least over the last year, so that was already priced in. So I've been keeping up with the Google case. I just haven't been putting that many updates about it, because honestly, it's not that fucking interesting. And I read the shit every day, and I'm bored. So that should tell you everything you need to know about the DOJ probe.
Yeah, Google might say their ad business is in decline, but how much in decline? They still make billions of dollars off of it. So I mean, is it like a 1% decline, which at their size is a lot of money, but still not something that you need to really worry about? You also want to keep in mind a lot of times the news is going to set things up for you to be liquidity. So, you know, take it with a grain of salt. I wouldn't necessarily use it as a, you know, like oh, we got to short Google now, or we got to take puts out on Google. It's probably going to be minor in the big picture. All right, we got 3 minutes till market close. I've got some K-Web for November, $50 calls. They're kind of far out, but I think we definitely could see a big move from China names. Still in my Snapchat, I bought some RGTI, $23 calls for next Friday, so that one's a little bit close. And then I got some BBAI, $7 calls for October in the 1K challenge.
I'm in nothing right now. I got $4.33 in buying power, so I'll be waiting until tomorrow to open any new positions. But just a thought, because I saw something from Google saying their ads business. Okay, understand one thing. Google Ads is a very small, like, sector of what most investors are banking on for their future. So this is why, if you ever hear me talk about a stock, the number one thing I'll say is, do you understand fundamentally what do they do and how they make money? Because if you understand those things, then having an understanding of what could potentially happen with that company makes it 1,000 times easier. So ads, yes, is it a big part? It is. But also, everyone's ad business is about to get watered down. Gemini is currently leading, and they have other AI products that are based off Gemini. So, like, it'll make up for that deficit that they potentially could see in ads over the next 12 to 18 months. Now, that is one thing you need to understand about Google is, like, to Eric's point, if they lose 5% of their ads revenue, that is nothing compared to a traditional, potentially smaller company. So that's really, like, what you need to understand is look at their business and then look at how they make money and then figure out what are the percentages that affect their bottom line that leads them into the black, the red, or the green. And once you have an understanding of that, it makes it easier to read into news that you may see that could be a potential detriment that really isn't, because it only makes up, let's say, 10% of their business, right? So that's just one thing to always stay aware of, especially with Google, Meta, Snapchat, even any of these big companies. Be cognizant of where do they make their money at the end of the day. If they're consumer driven, yeah, ads are a concern, but if they're not, then it is what it is.
My K-Web position's already up 10%.
I feel like China tech stocks are about to, over the next, like, 2 weeks, it's going to be stupid. If you didn't get in this week, you're going to be left sitting on the sidelines with your thumb up your ass, wondering what happened.
You and butthole jokes, man.
I mean, it's the most sensitive area for men. There's 32 G spots in there, so.
Baidu, we saw some more for October that just came in. I think those are pretty good. October 17th, 155, 12% move.
And not a horrible average.
I definitely think Baidu is going to continue to move up after the announcement.
Because at this point, the announcement's just going to be the Chinese government is going, like, internal for anything GPU, AI chip related at this point.
Yeah. Well,
so anyone who's making semiconductor components is going to pump.
I got 18 of you guys watching. If all 18 of you guys hit that like button right now, that's going to be our record number of likes on one of our live streams. So please go ahead and do that for us. That way we can get YouTube to push this out. I saw at the heights of our FOMC stream earlier, we had about 65 people watching at the highs. So it's working, but you guys help us out, do your part, hit that thumbs up. Hit that subscribe and the notification bell. Whenever we go live, especially on Wednesdays, we'll make sure that you guys can get in on this. Should have gotten into some positions. If you didn't, that's okay. I think tomorrow we'll still see a lot of opportunity and a lot of flow. But I will say today, in terms of, in my time of using stacks, from about 11:55 to probably like 12:45, so 11:55, almost an hour straight. We just saw, man, billions of dollars being spent on options. We just saw them pour money in. Yeah, we see a few puts and stuff here being bought for 0 days to expiration, but look at all that flow, guys. So hopefully you got yourselves into some good positions for the upcoming weeks. You know, depending on you, is it short term, is it long term? I like to get myself, right now I'm aiming for the October and the November strikes. I don't really love the you know, you got 2 days till quad witching, which is Friday, and then you have next week's as well. So just be careful with those ones. Volatility is going to be pretty high with those. But I think overall we had a pretty successful stream today watching FOMC, and I think a lot of the fears that we were expecting with the markets have kind of been calmed and are over, at least for now, for the temporary, you know, short term.
Yep, we'll see some stronger moves tomorrow.
There is a statistic about how when the markets are at all-time highs and you see a rate cut, like statistically there's like over a 90% chance that over the next month you'll see higher. Only a few percentage points, but still it is a data point to kind of consider that we very possibly should be heading higher with the markets in due time. This little head and shoulders pattern, I feel like we'll see. Is this a bull flag headed up further, or do we see, maybe we might see a gap down tomorrow and then recover, so who knows. Kind of crazy. SPY ended the day completely flat.
All that to end up flatter.
Then oh, I was waiting for an analogy right there.
and then a woman walking around with 2 CD cases in her back pockets calling it ass cheeks.
There we go. All right. Again, hit that thumbs up for us. We will be back on live on YouTube next Wednesday. If you're on our Discords or in our Stacks software, you guys will get our live streams in Discord. We'll be back at it tomorrow at market close. Real quick, yeah, we've got an earnings tomorrow for FedEx coming up. Oh, real quick, let me peek at Cracker Barrel.
talk about fold into social pressure real quick.
Yeah, I think this was expected. Cracker Barrel dropped.
I feel like they low-key did that on purpose. They were like, no one talks about us. Let's change our logo and take the old white man off it and see how upset America gets, because that'll give us an idea of how much people really think about us. Because nobody talked about Cracker Barrel before they took that man off the logo. That's all I'm going to say.
I will say that too, yeah. I mean, they made a splash, but not exactly the type of attention you want, especially for a publicly traded company. So I'm not surprised to see this drop.
Yeah,
I think that was kind of expected.
Anyone who thought Cracker Barrel was about to moon after earnings, well, you're probably the same people who don't understand that Cracker Barrel at the end of the day is a real estate company. They're not a restaurant. They are more concerned about how much space they own. Why do you think all of them are directly off of a freeway exit and none of them are in the middle of a city? You ever think about that? Yeah, you haven't, because you didn't even realize that until I just told you that like literally 90% of Cracker Barrels are off of a freeway exit. They're not in the city. They're not anywhere else. They are off of a freeway exit. I promise you that. And we have a ton of Cracker Barrels in Michigan. So
I have never seen nor been to one in my life.
I mean, I'll be honest, when you're hungover, the food's amazing. It's like going to IHOP in Las Vegas if you ever have done that. But with a hint of racism and a little bit of this doesn't feel right. So that's pretty much the only difference. It's just basically IHOP with very racial undertones if you're into that.
They have some badass mac and cheese. All right, well, I'm lactose intolerant, so I can't even have that. All right, guys.
You might as well told Eric that they have some badass like fiery Cheetos, because that man cannot eat cheese to save his life. Granted, I really can't either, but I'm about to eat a whole pizza, but I also have a whole bottle of Pepto-Bismol on my table too, so I'm willing to
well, you sound like you're feeling a little bit better after getting sick, so.
Oh my god, I can't. I don't. That's because I've also downed like half a bottle of Dayquil decongestion and Mucinex today, so hopefully that stuff kicks in overnight and I'm not feeling like I'm gonna die throughout the day like I have been all day today, if I'm being honest. Pizza's gonna be like the first thing I've eaten in the last like 8 days, FYI, so don't take your health advice from me when it comes to getting sick, because I've been drinking chicken and mini round noodles from Campbell's, microwavable soup cans, and eating pizza, basically.
Well, glad you're doing better. Hopefully you can jump on stream with us tomorrow for Discord. And,
I'll be on stream tomorrow for Discord 100%.
All right, guys. Yeah, Max will talk on off stream. I'm gonna say bye to everybody. Hope everybody had a good trading day and you're set up for the next couple days. Hope you enjoyed our live stream with FOMC. This is the first time we did FOMC together. So as we continue, we've been doing a lot more of these live streams with you guys. Hope you guys enjoyed it. Help us hit that like button, the thumbs up, not just the hearts on the chat. That way we can play this YouTube algorithm, get our videos out to more people. With that being said, happy trading. We'll see you guys tomorrow in our live streams in Discord. And if you haven't already, subscribe to Stacks. There's a code in the description box, closing bell 20, if you want 20% off your membership. You guys can see, like we showed you guys today, how powerful of a platform it is. If you were able to get into some of these positions, you know, give it a couple days, give it a few weeks. I'm pretty sure you're going to see some nice little profits and returns from those. All right, have a great rest of your day, guys.